Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Okay, so we're all living through this absolutely incredible digital revolution, right? It's all fueled by AI and this huge global energy transition. But what if this whole revolution is about to slam headfirst into a physical wall? And get this, it's a wall made of one of the world's oldest, most basic industrial metals, copper.
This right here is the core reality. You have to understand that the entire weightless, intangible world of AI, of cloud computing, of data itself, it's all anchored to the very real, very dirty, and very, very difficult business of mining. AI might be powered by code, sure, but as you're about to see, it is absolutely constrained by physics. And the single most critical physical constraint of all is copper. Just look at this number for a second. 29 years. That is the average time it now takes to permit and build a single new copper mine in the United States. To put that in perspective, that's longer than the time between the moon landing and the first iPhone. I mean, think about that. This one number sets up the entire conflict we're talking about today. A digital world that's moving at the speed of light and a physical supply chain that moves at a geologic pace. All right, so let's look at the first side of this collision course. We're talking about a massive, accelerating, and completely unprecedented new wave of demand for copper. This isn't your grandfather's cyclical demand, no. This is something entirely new, and it's being driven by the biggest names in tech and energy. This quote from Microsoft CEO Satya Nadella just perfectly reframes the whole AI race. You see, the game is no longer just about software or who has the fastest chip. It is a ruthless calculation of energy and materials. Every single token, every piece of AI-generated text or image has a physical cost in watts. And guess what you need to deliver those watts? Copper. The economics of AI have become the economics of electricity. And here's what that actually looks like in the real world. $34.9 billion. That's what Microsoft spent on capital expenditures in a single quarter of 2026. It's the largest single quarter outlay in tech history. And a huge chunk of that money is going directly into physical infrastructure, data centers, power systems, and all the copper wiring needed to connect it all. The scale here is it's staggering. An AI data center needs roughly double the copper per megawatt compared to a traditional one. Get this, a single server rack from NVIDIA, the heart of the AI boom, contains over 2 miles of copper cabling. By 2030, just data centers alone will need an extra 1.1 million tons of copper every single year. And that's not even counting giants like Oracle, which is out there raising tens of billions for its own massive AI build-out. But the AI demand shock isn't the only thing going on. It's being stacked right on top of another copper-hungry revolution, the energy transition. A typical battery electric vehicle, that requires about 3 times more copper than a traditional gas-powered car. So every single EV that rolls off the assembly line just adds more and more pressure. And we haven't even talked about the massive grid upgrades we'll need to charge all of them. So we have this unstoppable wave of demand coming at us. Now let's flip the coin and look at the other side of this vice, supply. And here's the crucial point. Copper supply is not flexible. It's rigid. It's constrained by what we're calling the 3 supply locks. These are deep, structural reasons why production just can't ramp up to meet higher prices, at least not quickly. And here they are. First, geological scarcity, which basically means that we're running out of the easy-to-mine stuff. Second, regulatory paralysis, making it nearly impossible to build new mines in places like the US. And third, the recycling time lag, which means recycling, as great as it sounds, simply can't fill the gap. Let's break each one down. Okay, lock number 1 is geological. The rock itself is changing. The average quality of copper ore around the world has been basically cut in half in just 3 decades. So what does that really mean? It means today, miners have to dig up and process 85% more rock just to get the same single pound of copper. That's more rock, more diesel, more water, more energy, more raw industrial force. The entire industry is running faster just to stand still. Lock number 2 is regulatory paralysis. And wow, the Resolution mine in Arizona is the perfect, if not painful, case study. This single deposit could supply a quarter of the total U.S. copper demand. It was discovered way back in 1995.
After billions of dollars were spent and decades of work, its final permits were just rescinded. As of today, it has produced exactly 0 copper. This is why it takes 29 years to build a mine in the US, and it's why so much capital is flowing to other countries.
Now for lock number 3, the one that a lot of people pin their hopes on, recycling. I mean, it seems like such an obvious solution, right? Well, the math is brutal. Copper infrastructure, things like pipes and wires, it lasts for 40 to 60 years. That means the copper being recycled today is from stuff built in the 1970s and 80s, back when we used a tiny fraction of what we consume now. Today's huge demand wave is being met by yesterday's tiny little wave of scrap. The arithmetic just doesn't work. So let's put it all together. You've got this unprecedented, explosive demand from AI and electrification, and it's crashing head-on into a supply chain that is locked up by geology, by regulation, and by the hard math of recycling. The outcome? Well, it's what analysts are now calling a generational squeeze. And that really is the central question of this whole story, isn't it? What happens when the insatiable appetite of the digital age meets the immovable reality of the physical world? Well, the data gives us a pretty clear and, honestly, a pretty stark answer.
This chart from Wells Fargo lays it all out. That red line is projected demand, which you can see stays stubbornly high. The purple bars? That's our projected supply from existing and announced mines, and it's expected to fall right off a cliff. The result is a potential global deficit of 30% by 2035. Look, that's not a small gap, that's a chasm.
And this right here, this really gets to the heart of the matter. You can order a bunch of GPUs and plan a new data center in just a matter of months. But you cannot summon the copper needed to power it on demand. That timeline, that runs in decades. This fundamental mismatch is the defining tension for all infrastructure spending for the next 10 to 15 years.
And this isn't some abstract problem for the future. It is happening right now. This number, a 22.4% year-over-year increase in the producer price index for copper wire and cable, is from February 2026. This is the wholesale cost inflation that's hitting every electrician, every home builder, and every data center developer in the country. Based on everything we've just seen, does this look like a peak to you, or does it look like just the beginning? So as this all unfolds, what should you be watching for? Here are 4 key signals. Keep an eye on that global ore grade. When it drops below 0.6%, the economics of mining get exponentially harder. Watch the producer price index for copper wire. If it's consistently running 15% above its average, that means inflation is getting locked in. And you've got to monitor U.S. import dependency and the success rate of our own domestic mine permitting. Think of this as the dashboard for the copper squeeze.
That's the data for today. Now, I want to hear from you. Can the AI revolution survive a copper shortage? Or are we hitting a physical wall? Drop your thoughts in the comments below. Don't forget to subscribe to Balance of Economy for high-density market insights. Stay sharp and stay informed.